Yes. Good morning to all. I am P.S. Vivekanand, Associate Professor from Department of BCom Corporate Secretary. Today I am just going to take about financial management. So, finance. What is finance? Finance is the lifeblood of business. The time and extent of the availability of finance in any organization indicates the health of a concern. So, actually, finance is needed to start every small businesses, which in turn it may expand to a big business units. So initially we start a business within the small sizes. In future, if you want to grow into big sizes, it may need to be finance. So meaning of finance, financial management. Financial management may be defined as the art and science of managing money. Financial management is concerned with the duties of the financial manager in the business firm. Objective of financial management. Objective of financial management is said to be proper mobilization of fund, proper utilization of fund, earning more profits, maintaining liquidity, overall efficiency and generating goodwill. This is the objective of business. Scope of finance function. Scope of finance function is said to be financial planning, designing the capital structure, selection of source of finance and selection of pattern of investment. So, in this, the pattern of investment is said to be what are the various sources available, which I will discuss in later. And I am just going to tell about the profit maximization and wealth maximization differences. Profit maximization doesn't take into account time value of money, whereas wealth maximization takes into account the value of money. And similarly, profit maximization does not take into consideration the uncertainty or risk of future earnings, whereas wealth maximization is considered both the factors of risk and uncertainty. And in profit maximization, dividend policy is not given due importance, whereas in wealth maximization, dividend policies are given more importance. And as well as in profit maximization, it doesn't consider about the long-term and short-term profits, whereas in wealth maximization, long-term and short-term profits are given more consideration. Capital structure. What is capital structure? A firm capital structure is the structure of its liability. So what is liability? Shareholders' funds and long-term debts are said to be the liability. In that, how the capital structure is framed. And what is long-term liability? Long-term liability is said to be the debt finance borrowed from the outsiders. Generally, it will be debentures or a loan from a bank or financial institutions. Whereas shareholder funds are said to be equity share capital, preference share capital or retained earning. These are said to be the capital structure. It composes the liability. So the various forms of capital. For starting a business, for need of finance, a person may choose a choice of whether go for equity or debt or retained earning or preference shares or loans. And now I am just going to teach about how to compute the EBIT analysis, earning per share. Using this format, we can calculate the earning per share, that is, which is suitable for deciding the best capital structure for the business when we need in money. The actual format starts with EBIT, that is earning before interest and tax minus interest. The interest payment will be occurred only if you are going to get a debt finance, that is either from the financial institution or any debentures. After deducting the interest, we will be getting earnings before tax, that is EBIT. From the EBIT, if you are going to deduct tax, the corporate tax, it's vary from 35 to 40%, depends upon the current scenario. And after deducting the earning after tax, you will get earning after tax. From that, we have to deduct dividend, that is payable to preference shareholders. So, what is the preference dividend payable has to be deducted from the earnings after tax. From the available, after deducting the preference share dividend, whatever the amount available is to be called as amount available to equity shareholder. Generally, while calculating earning per share, the formula is said to be amount available to equity shareholders divided by number of equity shares. For calculating the number of equity shares, it is better to prepare the number of count shares which is having in the company. That is, how many existing equity shareholders in the company, that is number of equity shares already exist in the company, it should be considered, and number of equity share we are going to issue to raise the finance as per the plan, it should be added. When you are going to add these two, you will get the number of equity shares available in the company. So the formula for calculating the earning per share is said to be amount available to equity shareholder divided by number of equity shareholders. Number of equity shareholders is said to be total number of old existing equity shareholders and the new equity shareholders as per the plans. Oh yeah, I just given a problem to discuss about calculation of EBIT and how to decide the best plan. Over here, and a company wants to expand its business with 5 lakh rupee and which will result in an EBIT of 1,20,000. So determining the best financial decision under EBIT and EPS analysis. See over here, as I just given a plan A, plan B and plan C. Over here in the plan A, I am having equity share capital per share costing 10 rupees for 2 lakh rupee and debentures 3 lakhs. And there's no preference share capital. Actually, I need 5 lakh rupee. I plan to get the money from the secure the finance from equity shareholders as well as from debentures. I'm not getting any fund from the preference shareholders. Whereas plan B, as per the plan B is said to be, I just plan to collect 1 lakh rupee from the equity shareholders, 2 lakh rupee from the debentures, and 2 lakh from the preference shareholders. So this is the plan B. Whereas plan C is said to be raising of equity shares value for 50,000 rupee and for debentures 4 lakhs, from debentures 4 lakhs bearing an interest percentage of 8% and from preference shareholders 50,000 rupees bearing the dividend payable 10%. Generally, when you are getting a finance from the outsider, that is from debentures, we have to pay them interest regularly. Even though whether you are getting profit or loss, it is immaterial, we have to pay the interest regularly. At the same time, if you are going to get a loan from raise capital from the preference shareholders, we have to pay them dividend. So this is the two differences, dividend and interest. So interest is payable to debenture holders or any loans from the outsiders, financial institutions, and or from the bank. So debt means financial institution, bank and debentures, whereas dividend is payable to preference shareholders. Over here, I just solved the sum. See, first thing, financial A. EBIT will be common for all the three plans. According to the plan A, I just mentioned the profit as EBIT is 1,20,000. In the over here, I just secured 3 lakh rupees loan from the debentures. For 3 lakh rupee, I need to pay interest of 8%. 3 lakhs into 8% will comes to 24,000. Just I mentioned over here in red color. Red indicates the money payment. So I am getting a profit of EBIT of 1,20,000 as per plan A, and I have to pay an interest of 24,000 for getting a loan from getting money from the debentures. After paying the interest, the balance available is called as earning before tax. That is 98,000 will be left behind with me. From the available profit, I have to pay the tax of 50%. So on 96,000, I have to pay the tax of 50%. It comes to 48,000. So balance after paying the tax will be earning after tax. It comes to 48,000. From the available profit, I have to pay the dividend. But in the plan A, I didn't get raised any finance from the preference shareholders, so it doesn't need me to pay any dividend to preference shareholders. So the available amount is said to be 48,000. It's available to equity shareholders. And number of equity share calculation. Over here, I just getting raising finance from the equity shareholders up to for 2 lakh rupees. Each share is costing 10 rupee. It shows that 2 lakh divided by 10 comes to 20,000 shares. So there are 20,000 equity shareholders are in my company as per plan A. So what is the amount available? 48,000 divided by number of shareholders as per plan A is 20,000 comes to 2 rupee 40 pies. This is as per plan A. Similarly, in plan B, as the condition EBIT will stand same 1,20,000 and interest payment as per plan B. I am getting a finance of 2 lakh from the long term debts, that is from debentures bearing 8% interest. For 2 lakh rupee, I have to pay the interest of 8%, which comes to 16,000. So I have to pay the interest of 16,000. From the available EBIT, that is earning before interest and tax, 1,20,000, I will be paying 16,000 as interest. After paying the interest, the available profit will be called as earning before tax. It is 1,04,000, and from the available profit, that is earning before tax, I will be paying a tax of 50%, which amounts to 1,04,000 into 50% comes to 52,000. So the balance is called as earning after tax. It is 52, and from the available, if any preference dividend payable, it has to be deducted. That is, as per plan B, I am getting a fund, raising a fund of 10% preference shares amounted to 2 lakhs. So that I need to pay dividend to the preference shareholders. Once we get a loan from the raising finance from debentures, we have to pay the interest. And the same way, if I get securing a fund from the preference shareholders, we have to pay dividend. But for 2 lakh rupee, I have to pay the dividend of 10%. It amounts to 20,000. After paying the dividend, the balance available with me will be 32,000, which is what the amount available to equity shareholder. As the case may be, in plan B, I am getting a fund from equity shareholders for a value of 1 lakh rupee, costing 10 rupees each shares. So number of equity shareholders said to be 1 lakh divided by 10. It comes to 10,000 equity shareholders. So this available 32,000 will be divided among the equity shareholders by 10,000. It comes to 3.2. So if you are adopting this plan, that is plan B, earning per share will be 3.20. So compared to plan A and plan B, which is higher. So plan A will be 2.4, whereas plan B is said to be 3.2. As per similarly, plan C. In plan C, I am securing a loan of 50,000 from raising fund of 50,000 from equity shareholders, 4 lakhs from debentures, and 50,000 from preference shareholders. Over here, I need to pay an interest of 8% on 4 lakhs. That is 8 lakh and 4 lakh into 8%. That is, and we needed to pay 32,000 as an interest. And similarly, I am just securing a 50,000 from preference shareholders, which is bearing a dividend of 10%. It will amount to 32,000. It is what I just shown over here. See, as per plan C, EBIT, earning per share is same, because whatever the plan may be, the earning before tax will not change. It is 1,20,000, and from that is called as earning before tax. From the earning before tax, I am deducting the interest payable, that is for the money secured from debentures or any loan. As per plan C, I am securing a money of 4 lakh rupees from the debentures, so I need to pay an interest of 32,000. So from the available 1,20,000, if I pay 32,000 as an interest, the balance left with me will be 88,000. From the 88,000, I need to pay a tax of 50%. So on 88,000, I have to pay a tax of 50%. It comes to 44,000. So the balance money available will be 44,000. From the available balance, I need to pay the dividend of 10% to the preference shareholders. It comes to 5,000 rupees. So once making the payment to debentures interest and tax, I will be paying the dividend of 5,000 rupees, and the available balance available is said to be 39,000. This is what the amount available to equity shareholders. So, as per the condition of Plan C, number of equity shareholders said to be 50,000 divided by 10, that comes to 5,000 shareholders. So, the money will be distributed among number of equity shareholders, that is the available money 39,000 will be divided among the equity shareholders of 5,000, which will result to 7 rupee 85. So, according to these plans, Plan C is said to be more profitable and beneficial to the company. Yes, thank you to all.